All right, let's dive right in. At the heart of pretty much all trading is one big choice. Do you ride the wave or do you bet on the tide turning back? Today, we are breaking down that exact battle, trend following versus mean reversion. And you're going to want to stick around because we're not just explaining the rules, we're going to solve a paradox that trips up even the pros. So this is the big puzzle we're tackling. Does it actually make sense to follow a trend when you're trading a spread, but bet against the trend on a simple price? On the surface, that sounds kind of contradictory, right? So let's pull back the curtain and figure out what is really going on here. Okay, so to get to the bottom of this, we've got to start with the basics. Let's really look at the two opposing forces that every single trader has to deal with, trend and mean reversion. Let me paint you a picture. Trend following, well, it's like betting on a rocket ship. You see it taking off, and you believe that momentum is just going to carry it higher and higher. Mean reversion, on the other hand, is the total opposite. Think of it like a pendulum. You're betting that no matter how far it swings out to one side, gravity, or, the market, is going to inevitably pull it right back to the middle. These are two totally different ways of looking at the world. So what's fueling that rocket ship? Well, trends are usually driven by these huge, large-scale forces that don't just change on a dime. We're talking about major shifts in economic policy, or those big waves of investor psychology, that classic risk-on or risk-off mood that can just grip the market for months. Mean reversion, though, is all about that gravitational pull. It works best when a price is tied to something real, something physical. Take a commodity, for example. Its price can't just skyrocket forever, because real-world things like storage capacity or how much is in inventory, they act like an anchor, constantly yanking it back toward its long-term average. All right, so we've got our two strategies, but that's only half the puzzle, right? We need to know where to actually use them. And this brings us to the difference between flat prices and spreads. Now, this is a really simple but absolutely crucial distinction. A flat price is, well, it's exactly what it sounds like. The price of one thing, like a barrel of crude oil. A spread, however, is the difference in price between two related things. So, for example, the price of oil in Texas versus the price of oil over in London. One is a solo flight, the other is all about the relationship between the two. Okay, now we get to the fun part. This is where we put it all together. We're going to match our two strategies, trend and mean reversion, with our two instruments, flat prices and spreads. And this is where we really start to solve that initial puzzle. This chart here lays out the core logic just beautifully. See, on one hand, you have flat prices. Those are driven by those big macro stories, right? They create persistent trends, so it makes sense to use a trend-following approach. But on the other hand, you've got spreads. Now, these are usually driven by the real-world logistics of things like storage and delivery, what traders call carry. And because these are just temporary imbalances, they tend to correct themselves pretty quickly, which makes them absolutely perfect for a mean reversion strategy. And this brings us to our golden rule. This is the first major takeaway here. You trade trend on flat prices, and you trade mean reversion on spreads. Let me say that again. Trend on flat prices, mean reversion on spreads. It's a simple, really elegant rule that's totally grounded in the fundamental economics of what you're trading. But you knew there was a but coming, right? In markets, there are always exceptions to the rule. There are some very specific situations where a spread just stops behaving like a simple convergence trade and starts acting like its own directional trending market. The reason why is pretty fascinating. We're not talking about simple supply and demand issues anymore. We're talking about huge events like sanction shocks or major regulatory changes. Just like the quote says, these are structural dislocations. Basically, the normal relationship between the two assets has been fundamentally broken. And in these rare cases, the spread itself starts behaving like its own trending market. Now, understanding this exception, well, it leads us to an even more interesting question. A paradox that seems to break the very rule we just established. And here it is, the paradox. A really popular strategy is called cross-sectional momentum, and it's basically buying the top performers in a group and selling the bottom performers. But hang on a second. Isn't buying one group and selling another just a big, complicated spread? And if it is, are we breaking our golden rule by trading a trend on a spread? This table breaks down the difference perfectly. See, a classical spread trade involves a super tightly linked pair, like two contracts for the same commodity in different locations. The whole bet is on their valuation link. Momentum is completely different. It's a diversified basket of loosely correlated, pretty independent assets. The bet isn't on convergence, it's a bet that the rank order of winners and losers is going to persist. And that gives us our punchline. Momentum is not trend on a spread. It's much, much better described as trend across spreads. You're not betting on one specific price relationship snapping back. You're betting on the broader pattern of relative performance continuing across a whole universe of things. It's a subtle but really critical difference. So with that paradox solved, we can now assemble all these pieces, trend, carry, and momentum, into a single unified framework. This is how we can see how these seemingly contradictory strategies can actually coexist and thrive in the same market. This chart basically gives us our grand unified theory. Think of it like a map of the different ways to earn a return or a risk premium in the market. You've got three distinct strategies: trend, momentum, and carry. Each one operates in its own domain: flat prices, cross-sections, or spreads, and each one is designed to capture a completely different type of return. They don't compete with each other at all, they actually complement each other. The key takeaway here is that you've got to use the right tool for the right job. Trying to trade a trend on a carry spread is like using a screwdriver to hammer in a nail. It's just not going to work. Each strategy has a unique purpose. Trend is for capturing returns when the future is really uncertain. Carry is for earning a premium by providing liquidity, and momentum is for profiting from the persistence of market information. Wow, we have covered a lot of ground. So let's boil all of this down into a few clear, actionable takeaways that you can actually use. It really comes down to these three simple rules of thumb. Number one, trade trend on flat prices to capture those big macro moves. Two, trade carry in mean reversion on spreads to profit from their convergence. And three, trade relative trend across a whole universe of assets using momentum. And here it is, the most powerful way to remember all of this. Trend is about convexity, that potential for unlimited upside. Carry is about liquidity, earning a return for warehousing risk. And cross-section, or momentum, is all about persistence, the idea that winners just keep on winning. Each strategy taps into a completely different fundamental driver of market returns. So we'll leave you with this final question. Now that you have this framework, how might you look at your own portfolio differently? Can you maybe identify which of these forces you're actually exposed to? Because understanding the difference is absolutely key to building a more robust strategy. Thanks for joining us.